Imagine this. You've finally done it. You left Canada, starting a new life in a new country, sipping margaritas on the beach. Then an email from your accountant lands in your inbox. Hey, by the way, your TFSA isn't tax-free anymore and your RRSP is triggering withholding tax. Turns out leaving Canada doesn't just change your address, it changes the rules for all your financial accounts. And in this video, I'm going to show you what happens when you move abroad and how to protect your TFSA, RRSP, RESP, FHSA, and RPP, like your private pensions, from costly mistakes. Stick around to the end for a summary cheat sheet that you can screenshot for your future reference. Let's start with the TFSA. We love it for its tax-free growth, but the rules change big time when you become a non-resident. The good news first, there's no departure tax on your TFSA and you can keep it open. But here are the catches. There's no more contributions allowed once you're a non-resident. Your contribution room also freezes for any full year that you're away. And if you slip up and contribute, that's a 1% monthly penalty tax. And here's the real kicker. Your new country might tax it. The classic example being the US. Meet Summer. She moved from Canada to the US and kept her TFSA, thinking gains would stay tax-free. Huge mistake. The US treated it as a foreign trust, meaning Summer faced US taxes on her TFSA's income, gains, and faced complex reporting. Her tax-free dream became a tax nightmare abroad. Withdrawals from your TFSA are still tax-free in Canada, and that amount is added back to your TFSA room next year, usable only if you return to reside in Canada. So what are some options for your TFSA if you're leaving Canada? Well, consider cashing it out before you go. That's often the simplest. You could also keep it in depending on the tax treaty of the country that you're moving to. But what if your situation is more complex? While these are some common paths for your TFSA itself, more advanced strategies for your overall wealth do exist. With the TFSA cash, for example, you can then reinvest it in your new country under their rules or use it for your move. There's a lot of different options. Next up, I want to talk about the RRSPs, but before we get into that, there's something you need to know. Leaving Canada is not a simple process. Get it wrong and the consequences can be serious. We're talking unexpected tax bills, double taxations, or even huge penalties for missing key filings. This is why understanding the rules before you move is so important. Once you're already abroad, fixing these mistakes is exponentially harder and sometimes impossible. And that's exactly what we help people navigate here at Blueprint International with our Exit Canada planning services. So check that out if you're thinking of moving. Okay, now on to the RSP. If you're planning to take your Canadian RSP or RIF on an international adventure, well, then when you become a non-resident, the rules for these retirement mainstays change. Some good news. The RSP and RIFs are exempt from Canada's dreaded departure tax, and you can maintain these accounts even while living abroad. Now let's talk about contributions. Once you're a non-resident, adding more to your RSP is generally off the table, and your contribution room usually freezes. However, a useful strategy often exists in your departure year. Contributing up to your limit can help reduce your final Canadian income tax bill. Withdrawing funds as a non-resident means a standard 25% Canadian withholding tax. But there's a path to reduce this. Tax treaties with countries like the US can often lower that rate on regular periodic payments, sometimes to 15% or even lower. Your withdrawal method matters. Your new country will also likely tax this income, but foreign tax credits typically prevent being taxed twice. Canada has tax treaties with 91 different countries, with some of the most common ones like the US, Mexico, Costa Rica, and Thailand, and you can find the full list here. For those moving to the US, Dave's experience in California is a key lesson. He filed this article election with his first US tax return. This election is made by attaching a statement to the first US tax return, Form 1040, after becoming a US resident. While this might seem like a small step, it's essential because it allowed his Canadian RSP to continue growing tax deferred from a US perspective until he withdrew the funds. Forgetting this could mean facing annual US taxes on his RSP's internal earnings. And don't forget, home buyers or lifelong learning plan balances, they typically need repaying around when you leave Canada or their taxes income. A pre-departure RSP contribution can often resolve this. If you're serious about moving overseas, it's crucial to know and understand your net worth first. You can download my free visual net worth tracker from my website. The link is in the description. Let's take a look at Canada's first home savings account, the FHSA, a very new account. It's a great tool for aspiring Canadian homeowners, offering very powerful tax perks. But if you open an FHSA, start saving, and then your life adventure takes you outside of Canada before buying that home, what happens? Well, the rules for non-residents change the game significantly. First are some reassuring points. Again, there is no departure tax on your FHSA if you leave Canada. And you can generally keep it open even after becoming a non-resident. However, the major plot twist concerns the FHSA's primary benefit. That amazing tax-free withdrawal for your first home. Consider Alex. Alex opened an FHSA, diligently saving for his first home. Then a job overseas led to a move. Later, when Alex wanted to use the FHSA funds as a non-resident, that special tax-free qualifying withdrawal, it was no longer an option. The main FHSA advantage was lost. So if a non-resident like Alex withdraws money, it automatically becomes a taxable withdrawal in Canada. The amount is then added to Canadian-sourced income, and Canada applies a non-resident withholding tax, typically 25%, though a tax treaty might offer a lower rate. And thinking about continuing contributions as a non-resident, well, it's highly unlikely that this is allowed. Your FHSA room probably won't grow, but since it's a very new account, get direct CRA or tax pro clarification, but plan for no. The clear takeaway, if you open an FHSA, then move abroad before buying a Canadian home like Alex, its powerful advantages really decrease. Contributions were deductible, and that's great, but any withdrawal becomes taxable. Critical shift for non-residents. Now let's talk about RESPs, those education plans we love for the government grants. But if you're moving out of Canada with an RRSP, be warned, non-resident rules will change it drastically. The good news first, again, there is no departure tax if the subscriber, usually the parent, leaves Canada. And you can generally keep the plan open. But it gets very tricky. While you can continue to contribute to the RRSP after moving abroad, it's important to note that the Canada Education Savings Grant, or the CESG, is only paid if the beneficiary is a resident of Canada at the time of each contribution. If the beneficiary is not a resident, contributions made will not attract the CESG or other government grants. That's a significant impact on the growth potential of the RESP. The real eye-opener is often with educational assistant payments, otherwise known as EAPs, as Kimmy's family discovered after moving abroad. When Kimmy, now a non-resident, started university and they looked to use her RESP, the government grant money, such as the CESG and the CLB, that had accumulated in the plan was generally not paid out to her as part of the EAP. These grant amounts were effectively unavailable for Kimmy's immediate university expenses. For Kimmy's family, this meant a significant portion of the education fund they anticipated wasn't available for her studies as expected. On top of that, investment growth in EAPs paid out to a non-resident student faces Canadian withholding tax, usually 25%. For subscribers, your new country of residence, like the US for example, might also tax the RESP's annual earnings, potentially classifying the plan as a foreign trust for their tax purposes. The bottom line for RESPs, if you're leaving Canada for good, especially if the student's a non-resident, weigh whether keeping it is worth losing grants and potentially facing extra taxes and headaches. You might want to reconsider. Now let's talk about Canadian employer pension plans, otherwise known as RPPs, when you're moving abroad. So if you're leaving Canada and have an employer pension plan, whether it's a defined benefit or defined contribution plan, here's what you need to know. Good news first, again, there is no departure tax on your RPP when you leave Canada, and you can typically still receive your pension payments internationally. However, these payments automatically face a 25% Canadian withholding tax right off the top. But again, the key is that you could often get this rate significantly lowered if Canada has a tax treaty with your new country of residence, for instance down to 15% for regular periodic payments if you move to the US. Note that for lump sum payments, if your plan even allows them, might be treated differently under different tax treaties. But, and this is crucial, you must proactively apply for this tax reduction. This usually involves submitting Form NR5 to the Canadian Revenue Agency or the CRA, or providing specific forms like the NR301 series to your pension plan administrator. And if you don't take these steps, your payer has to withhold the full 25%. And while you might be able to claim back any overpayment later by filing a Canadian non-resident tax return, it's far better to have less tax taken right from the jump. But it doesn't stop there. Your pension will also likely be taxable in your new country, though a foreign tax credit might be available to prevent double taxation. You'll receive an NR4 slip from your pension payer showing the Canadian taxes paid. And here is a pro tip. Contact your RPP administrator well before you move. Ask about their specific procedures for non-resident pensioners, your payment options, and exactly how to apply for those treaty reduced withholding tax rates to ensure that your pension income transitions smoothly. All right, so here's the cheat sheet that I promised earlier. You can pause it here and take a screenshot for your future reference. As you can see from this table, most people underestimate how complex this gets. The moment you leave Canada, the tax treatment of your account shifts. And if you're not prepared, it can really cost you. We've seen people lose grant money, face unexpected taxes, or get hit with steep penalties just for missing a simple form. And once you're abroad, fixing these mistakes is way harder. That's why planning ahead is so important. And at Blueprint Financial, we help Canadians move with clarity, avoid costly surprises, and keep more of what they've earned. Check out our website to learn more about our Exit Canada planning, and don't forget to like and subscribe if this was helpful.